Yeah, thanks, Tim. So first of all, thanks everyone for joining. I think some people are going to be late as well, but the way this is going to go, the first 10 or 15 minutes, I'm going to present on the stock market Q1 and maybe a bit of the outlook for Q2. And then later on, the API team are going to talk about property in the UK as an asset. And I know a few people before have asked me about getting a mortgage as a non-UK resident. So perhaps that'll be touched on, or indeed in the question and answer session. So if we go to the next slide then. So to talk about the best performing stock markets, now this wasn't until a couple of days ago, but you can actually see that some markets that you wouldn't expect have started the year very well. So for example, the Stockholm index in Sweden, we've got Chile, Kazakhstan, some emerging markets, frontier markets like Ukraine as well. And there's a lot of speculation about why this could be. A lot of people think people are looking for non-US assets now because US markets have done so well for so long. And also now people are feeling more optimistic about the world because of vaccines and so on. So some of the more risk-on assets, if you like, some of the emerging markets that tend to do well when people are feeling more optimistic are doing quite well. If we go on to the next slide, we can see that some of the bigger markets, like some of the more established markets, some have still done very well. So for example, the Dow Jones in the US is up by 8%. Now, considering this is the first quarter, that's an annualized return of 32%. That doesn't mean it's going to happen like that, but that's a pretty high return. And the Italian market, which hasn't exactly been one of the best performers, has done very well when it comes to the traditional market. Now, what's interesting is the NASDAQ that did so well last year has only been up by less than 2% so far until March 28. So what we're seeing is we are seeing some assets go away from technology. Of course, long term, we're only going to use more technology, right? But some of those assets that did particularly badly last year, like the UK market, the Italian market, they didn't recover, and they still haven't fully recovered from the crash of last year, are starting to do better. And even if you look at the US market, the Dow Jones compared to the S&P and especially the NASDAQ is more traditional companies, like the Italian market, like the UK FTSE 100. It's full of banks, oil companies, and so on. So some of those traditional companies, there's now more optimism that finally we'll be able to get out of this and go to a new normal or back to the old normal. I doubt we're going to fully go to the old normal, but nevertheless, there's more enthusiasm now about some of those kinds of companies, which is then meaning that even say the DAX in Germany is regularly hitting record highs. It wasn't always doing that last year. So we are seeing a bit of a rotation there. But if we go to the next slide, we can see that not all markets have done well, of course. So the Caracas stock market in Venezuela, I mean, that's a bit of an extreme, of course. That's down by minus 99%, although I don't think many people here would have invested necessarily in the Venezuelan stock market. But we can also see Latin America in general. I know Chile did well, but you've got Argentina, you've got Colombia have done pretty badly. China, which did relatively well last year as a stock market, not as well as the NASDAQ, but it was in the top 10. It's been pretty much flat, but just minus a little bit. Some days it's up, some days it's down. But if we move on to the next slide and we look at the general trend, we can see that US markets and most established ones are up, but to different extents, right? You've got the Dow Jones, the German DAX, which are up by quite a lot, the FTSE 4 or 5%, others which are up by less. But the general trend is we have started relatively well, but it's slower growth than what we saw November, December 2020, and indeed after the lows of March, because of course, if you think back, markets were so cheap, and then with the vaccine, and then the US election came and went, so that uncertainty came and went. November and December were incredible times, right? So it couldn't have kept up like that forever, where markets and assets were going up like crazy. So we have seen a slowdown, especially in technology, but technology has still marginally gone up. Msci World is up by over 1.5% this year, 29% year on year, but bear in mind this time last year was pretty much a crazy time, right? Whereby everyone was worried about COVID. So if you compare to the end of March 2020 to the end of March 2021, we're up by almost 30%. But what's interesting is emerging markets, which have done very badly, for 10 or 12 years relative to the US market in particular. It's up by already close to 4% this year on year, 36%. And last year, the South Korean stock market, which believe it or not, is still considered an emerging stock market, because when MSCI Emerging Markets was created, Korea and Taiwan and Hong Kong were seen as emerging markets. South Korea actually did better than any other stock market last year, included, well, if you include the NASDAQ, it would be number 2, but it did better than the US stock market, Taiwan, China, and so on. But also the likes of Taiwan, others did very well. And some of the frontier markets, as we saw on the first slide, have done very well. So if we move on then to the next slide, if we look at some of the trends, so some underperforming assets or previously underperforming assets are doing quite well. So emerging markets, the UK market, the UK FTSE 100, it's not going crazy, but it's up by close to 5% this year. The Japanese Nikkei, even though it's calming down a little bit, it's hit 30,000 for the first time in a long time. And what's interesting is small cap companies are outperforming. So if you look at the FTSE 250, which is smaller companies than the FTSE 100, it's doing better than the FTSE 100, which is doing relatively well. And the Vanguard Global Stock Cap Index, it's up by close to 60% year on year compared to the March lows, and 15% this year. Because if you think about it, when the pandemic came, the Zooms of this world, the Amazons, the Apples, they did incredibly well, right? The big caps, which were in technology, did well, but the small cap companies, unless they were technology companies, were hit the most, right? The restaurants, the airlines, smaller airlines, I mean, in particular. But now, when we've got more optimism about the future, you're starting to see some of those medium and small caps do better. And also, I'm not going to talk about this too much because I know you guys are going to talk about it, but real estate. If you look at real estate investment trusts, REITs, they did not and still have not fully recovered from March 2020. Even by the end of this year and early this year, most REITs are basically close to came back to where they were. So REITs are actually doing quite well. Real estate funds have actually started to do quite well this year as well. They haven't fully came back to where they were, but that shows they're undervalued in many ways. So the likes of REITs, the UK market, emerging markets, all those areas that got hammered previously have actually done quite well the last 6 months, and especially Q1. So if we go to the next slide, now this is very interesting. And at the moment, there's a big debate because Joe Biden has got this huge stimulus. And what we can see here is if you look at the green line is the output gap. In other words, how much was lost from the US economy. So if you look at 2008, 2009, the green line, it was much less severe than COVID, right? Because there was not a slowdown. But the stimulus, the blue line is the output gap. And you can see it's much lower than 2021. But if you look at the stimulus or the gap between the two lines, you can see that in 2021, there's a huge stimulus when the economy is actually projected to do very well. So the US economy this year is projected to grow by up to 7 or 8%, which is higher than China. So a lot of people are saying that QE, 0% interest rates, it wasn't inflationary in 2008 and 2009 for many reasons. But some people are saying, including Larry Summers, who used to be in the Obama administration, that basically this time could be a bit different because the economy is going to be super hot. There's stimulus from the central bank. But in addition to that, now you have huge fiscal stimulus. And you can see that not only is it much bigger than 2008 and 2009, the gap between how much stimulus has been thrown at the problem compared to what the problem is, if that makes sense, is much bigger, right? So we don't know that for sure. I suspect it's not going to be incredibly inflationary. I'm not an economist, I can't know for sure. I did watch the debate, an interesting debate between Paul Krugman, the Nobel Prize winning economist, and Larry Summers. And Krugman thinks there won't be inflationary, Summers think it might be, or he says it's a 1 in 3 chance, basically, that it could be inflationary. I personally think it won't be overly inflationary. But what's interesting is if there's speculation that inflation could push up, Of course, some people want to get into assets that are going to pay more than the bank, and this could indirectly affect asset prices. Now, for Q2 and ongoing, of course, I can't know the future. There's so many unknown unknowns and known unknowns. You know, we could have more variants. We could go back into lockdown, which could therefore mean the technology firms do even better. We can't know all the variables, but I personally think markets and assets are looking good because there isn't much alternative to put your money in the bank these days. I do think some of the undervalued markets will do better than maybe the US markets have done because the US has outperformed for so long. But nevertheless, if we see an unexpected occurrence, like for example, let's say we go back into lockdown because the variants are so bad that we need to lock down again, I think you would see then people rush back towards the dollar like they did in March last year, rush back into US markets. So I would stay diversified. I wouldn't try to predict the future, but my own sense is that if we're talking this time next year, the general trend will be higher asset prices because of what's happening in the world. And those sectors that were absolutely battered by the falls last year, including things like real estate investment trusts, the UK market, and others will do quite well. And talking about the UK, which I know you guys are going to do with the property, at the end of the day, Brexit has been sorted out now. People might not be happy with the outcome, depending on their political opinions, but Brexit has been sorted out. So you would think that the mainland European stocks, UK stocks, and indeed asset prices, hopefully after a few years of underperformance, we might actually see some overperformance now that a lot of the uncertainty has gone away. And as a final comment, if you look at the price to earnings ratios around the world, and I'm not saying they're a perfect way of looking at assets, but various ratios, the UK market and certain emerging markets and also Japan look incredibly undervalued compared to some other markets. So assuming we get back to some kind of near normal or new normal, I think those assets could do quite well in the next few years. But I'll pass over to you guys.
How can I help you? In two ways. First of all, are you an expat, a high net wealth individual, or just somebody who lives in a part of the world where it's difficult to get access to quality investment solutions? In which case, go onto my website on adamfayed.com and find out more. If you don't fit into any of those categories, then in which case there's a range of free material on my website, on this YouTube channel, and indeed on my Quora, where I get over 200 or have received over 231 million views in the last few years. And finally, if you want to actually read my thoughts in more detail, go onto Amazon and find my book on there.